All right, let's kick things off. You know that annual ritual that descends upon us, often shrouded in a bit of mystery and a lot of numbers.
Oh, yeah. Tax season.
That's right, tax season. For many, it feels like an impenetrable maze of forms and figures. But what if I told you that tucked away in those seemingly dry documents are not just obligations, but genuinely surprising insights and even, hitting opportunities for your finances?
That would be quite something.
That's precisely our mission today on the Depth Dive. We're going to pull back the curtain on one of the most common yet frequently misunderstood tax forms out there, the Form 1099 DIV, focusing specifically on dividends and distributions.
A classic.
Think of this as your personal shortcut to truly being well informed about a crucial piece of your financial puzzle, the income you receive from your investments. We're here to help you turn confusion into clarity and maybe even find a few extra dollars in your pocket.
And that's the beauty of it, really, that this isn't just about compliance or, ticking boxes. It's about empowerment. Understanding the nuances of this form means you can identify key details that directly impact your overall tax situation, revealing potential pathways to beneficial tax treatment.
Right.
We're going to move beyond merely reading the lines. We'll explore it box by box, revealing what each piece of information means, why it matters, and crucially, how it can affect your bottom line. Prepare to decode this financial blueprint with us.
And to make sure we're giving you the most accurate and actionable insights possible, everything we discuss in this deep dive is drawn directly from the official source. The instructions for Form 1099 DIV, revised January 2024, straight from the Internal Revenue Service. So let's begin unpacking this essential form. So let's establish our groundwork. What is Form 1099 DIV at its core? I like to think of it as your annual financial report card, specifically for dividends and other distributions you've received from your investments.
That's a good way to put it.
We're talking about income from things like stocks, mutual funds, and various other entities you might hold. It's the official communication from the payer, that's the company or the fund that paid you, both to you, the recipient, and perhaps more importantly to the IRS. They're essentially telling Uncle Sam exactly what they've paid out to you in investment income.
Precisely. And the significance of this form cannot be overstated because the income detailed on it often has a unique tax identity. Unlike, say, your regular salary, which is typically straightforward ordinary income, dividends can be treated in different ways for tax purposes.
Okay.
Some might be fully taxable at your highest rates, while others could qualify for significantly lower capital gains rates, and some might even be tax-exempt at the federal level. Knowing these distinctions is key to correctly filing your taxes and potentially saving a considerable amount.
That really highlights how important it is for investors to pay attention to the details here. But then for us, who's actually sending us these forms? Is it just big corporations, or can even smaller transactions trigger this requirement? What compels a payer to issue a 1099 DIV in the first place?
That's an excellent question, and it's something many people wonder about. It's the payer's responsibility, the corporation, the mutual fund, or other financial entity. They're obligated to issue a 1099 DIV if certain thresholds or conditions are met. And knowing these helps you anticipate receiving one.
Right.
Firstly, if they've paid you dividends, and that includes capital gain dividends and even exempt interest dividends or other distributions valued at $10 or more in money or property.
$10? Really?
Yes, that's right, just $10 can trigger this form.
Wow.
Secondly, they'll issue one if they've withheld and paid any foreign tax on dividends on your behalf. This is important for those with international investments, as it can open the door to foreign tax credits, which we'll definitely discuss later. Thirdly, if they've withheld federal income tax from your dividends under what's called backup withholding rules. In short, this means they've withheld taxes because of an issue with your tax ID, and we'll deep dive into that later, but it's a key indicator something might be amiss.
Right, a red flag potentially.
And finally, if they've paid you $600 or more as part of a liquidation, this signals a more substantial transaction, perhaps from a company going out of business or selling off major assets.
Wow, that $10 threshold often catches people by surprise. It really underscores just how ubiquitous this form is, even for small amounts. It's not uncommon for someone to receive a 1099 DIV for just a handful of dollars and think, is this even worth reporting?
And the answer is always yes. Always.
Exactly. Always yes. Now, I understand there's been a significant, fairly recent shift in how these payers file their returns with the IRS, particularly regarding e-filing. This affects us as recipients, too, even if it's kind of behind the scenes.
Absolutely, and it's a big deal. The Taxpayer First Act of 2019 authorized new regulations, and TD 9972, which was published back in February 2023, officially lowered the e-file threshold dramatically.
Okay.
Before this, many payers might have simply mailed in paper forms. But now, for returns filed on or after January 1st, 2024, the e-file threshold is a mere 10 returns.
Just 10 total.
Yes, and this isn't 10 of just one type of form, mind you.
Yeah.
It means if a business files a total of 10 or more information returns across all types, including 1099 DIVs, 1099 INTs, W-2s, and so on, they must e-file.
Wow.
This is a clear signal of a broader ongoing move towards electronic reporting and data exchange between payers and the IRS. It aims to make the entire system more efficient and, ideally, more accurate.
That's a massive shift in how information moves from companies to the IRS. But from our perspective as the recipients of these forms, it actually seems like a good thing, right? It implies that a significant portion of our tax data is already in the IRS's system, automatically reported.
Precisely. While it's the payer's responsibility to adhere to these rules, understanding this change reinforces that there's a sophisticated automated system in place for your tax data. It means the IRS likely has a good portion of your investment income information before you even begin preparing your return. This is exactly why it's so critical for the Form 1099 DIV you receive to accurately reflect what they've reported. It helps prevent discrepancies that could trigger questions later.
Okay, so we've explored what is typically reported on a 1099 DIV, but what about the things that people might assume are dividends but actually aren't reported on this form? It's just as important to know what isn't there so you don't accidentally get confused or, worse, double report income.
That's a crucial distinction for avoiding common pitfalls. First, taxable dividend distributions from life insurance contracts and employee stock ownership plans, or ESOPs, are not reported on Form 1099 DIV.
Okay, so where do those show up?
Those are actually reported on Form 1099-IR, which is for distributions from retirement plans. Different form entirely. Second, substitute payments in lieu of dividends. These often come into play if your broker has loaned out your securities.
Right.
They're typically reported on Form 1099 MISC, or sometimes on a composite statement you might receive from your brokerage.
Got it.
Third, payments made to certain entities are generally exempt from 1099 DIV reporting altogether. This includes payments to corporations, tax-exempt organizations, IRAs, Archer MSAs, health savings accounts, HSAs, U.S. agencies, states, the District of Columbia, U.S. possessions, or even registered securities or commodities dealers.
Why is that?
These entities have different reporting requirements because of their unique tax statuses. They're handled differently by the system.
Makes sense.
And here's one that often trips people up, especially given the word dividend in their name. Distributions from cooperative banks, credit unions, domestic building and loan associations, and mutual savings banks.
Oh yeah, I could see that being confusing.
While they call them dividends, the IRS considers them interest income. So if you hold money in these types of accounts, you'll find those reported on Form 1099 INT, not 1099 DIV. The underlying financial product determines the reporting, not just the name they use.
Wow, so you really have to pay attention to the source and nature of the payment. These distinctions aren't just arbitrary bureaucratic rules, are they? They reflect fundamentally different underlying financial instruments and how the IRS classifies income for specific tax treatments. It really highlights how complex this can get if you don't know the specifics.
Exactly. Each type of income has its own set of rules for taxation, and misclassifying them could lead to incorrect tax calculations or, even worse, missed opportunities for beneficial treatment. It's all about putting the right piece of information in the right tax bucket.
And finally, before we dive into the boxes, I've seen these forms referred to as continuous use. That sounds a bit unusual for a tax document that gets updated. What exactly does that mean for us as users of this information? Does it imply they're more stable than other tax forms, or is there a nuance there?
That's a great observation, and it's a practical implication for anyone seeking information about them. It means they're not revised annually like some other tax forms, which get a brand new revision every single year.
Right.
Instead, these forms and their instructions are updated only as needed. This emphasizes the importance of always checking irs.gov form 20999-DIV for the most current version, especially if you're dealing with anything complex or looking up information later in the tax year.
A tip.
It also means these specific instructions for Form 1099-DIV are part of a broader set of general instructions for certain information returns. This larger document covers overarching rules like who must file, when and where to file, electronic reporting specifics, how to correct errors, statements to recipients, taxpayer identification numbers, backup withholding, and penalties. It's a whole ecosystem of rules that this particular form fits into, which is continuously updated.
All right, let's get into the heart of the matter, the boxes themselves, starting with Box 1A and Box 1B. This is where things get really interesting, especially when we talk about tax savings and how to optimize your investment income. Let's start with Box 1A, total ordinary dividends. This seems like the foundational figure, the baseline for all other dividend calculations, right?
That's spot on. Box 1A represents the grand total of dividends and other distributions that are generally considered ordinary income for tax purposes. This includes a broad spectrum of payments. Think dividends from money market funds, net short-term capital gains that are passed through from mutual funds, and various other distributions on stock.
Okay.
It's the total pool of income that, absent any special treatment, would be taxed at your regular income tax rates.
Gotcha.
And here's a common aha moment for many investors. It also includes reinvested dividends. So if you've opted to have your dividends automatically put back into buying more shares of the same stock or fund,
Which a lot of people do.
right? Very common. Even though you never physically see that cash, the IRS still considers that reinvested amount as taxable income in the year it was reinvested.
So even if I don't see the cash, if it was reinvested, it's still taxable income.
Absolutely. That's the key insight here. Don't be surprised if your taxable dividend income looks higher than your cash payouts. It's likely those phantom reinvestments at work, and you need to account for them. This box also includes what are called Section 404(k) dividends, which are specific payments from employer securities that are directly paid to plan participants or beneficiaries. Those are also considered ordinary dividends.
That's such a crucial detail for accurate reporting. Many people miss that, thinking, I didn't get any cash, so why is this taxable? It just shows how important it is to look beyond just the cash in your bank account. And speaking of specific entities, you briefly mentioned S corporations earlier.
Yes, for S corporations, it's a bit of a nuance. They only report dividends on Form 1099 DIV if those distributions are actually made out of accumulated earnings and profits during the tax year. This is a specific accounting scenario that differentiates them from regular C corporations.
Okay, so Box 1A is our big, comprehensive bucket of ordinary dividends. Now let's talk about Box 1B, qualified dividends. This is where the real tax-saving opportunity often lies, isn't it? This is the golden ticket for many investors.
Absolutely. This is where you can see a significant difference in your tax bill. Box 1B contains amounts that may qualify for those significantly lower capital gains tax rates.
Nice.
These rates are often much more favorable than your ordinary income tax rates, and that can translate directly into substantial tax savings. Generally, qualified dividends are defined as dividends paid by domestic corporations, and what the IRS refers to as qualified foreign corporations.
This sounds like an amazing benefit, but I'm guessing, like with most things tax-related, there are always conditions or exceptions. When are dividends not qualified, even if they show up on your 1099 DIV? And how can a listener ensure they don't miss out on this benefit?
You're right, there are crucial exceptions, and the holding period rules are perhaps the most critical determinant for qualification. This is where it can seem a bit technical, but understanding the principle is essential for securing that lower tax rate.
Okay, let's break it down.
For general stock, the rule of thumb is this. A dividend is not qualified if you held the stock for less than 61 days during a specific 121-day period. This period begins 60 days before the ex-dividend date.
Which is the date a stock starts trading without the value of its next dividend payment, right?
Exactly. That's the key date. So 60 days before the ex-dividend date itself and 60 days after. That's your 121-day window. You need to hold it for at least 61 days within that window.
And why these specific rules seems a bit arbitrary.
Well, the why behind these rules is very important. They're designed to ensure investors aren't just briefly holding stock solely to capture dividends at a lower tax rate, a practice sometimes called dividend capturing.
Oh, okay. Makes sense.
The IRS wants to see you're a genuine longer-term investor to grant that reduced tax rate. When counting those holding days, you include the day you disposed of the stock, but not the day you acquired it. Also, crucially, you cannot count days during which your risk of loss was diminished, which generally means you had some kind of hedging strategy in place that offset your exposure to the stock price movements.
Like options or short sales?
Precisely. Things that reduce your risk. Now, for preferred stock, the rules are slightly different. If the dividends are attributable to periods totaling more than 366 days, They are not qualified if you held the preferred stock for less than 91 days during a 181-day period that began 90 days before the ex-dividend date.
Okay, longer periods involved there.
Yes. Preferred dividends for shorter periods are generally subject to that 61-day rule we just discussed. While the precise calculations can be complex, and your tax software or professional will handle the exact dates, the key takeaway for you, the listener, is to understand that your holding period is paramount to securing this tax advantage. If you're quick trading, your dividends likely won't qualify.
So the practical takeaway for the listener is incredibly clear. Don't just look at the amount in Box 1B. Also consider how long you held that investment. It's truly paramount if you want to secure this tax advantage. What are some other scenarios where dividends might not qualify?
Other scenarios include dividends that relate to payments you're obligated to make concerning short sales, or positions you hold in substantially similar property that reduces your risk. Also, dividends paid by regulated investment companies, or RICs, and real estate investment trusts, or REITs, that are not specifically treated as qualified dividend income under specific IRS sections like 854 or 857C, and, as we mentioned earlier, deductible dividends paid on employer securities under Section 404K are explicitly not qualified dividends. These are ordinary income through and through, with no special tax break.
That makes perfect sense. Now, you mentioned qualified foreign corporations. For those of us with diversified portfolios that might include international investments, how does a foreign corporation qualify? Because that can also impact whether those dividends get that lower qualified dividend tax rate.
That's a vital consideration for international investors. A foreign corporation is considered qualified if it meets one of two main criteria. First, if it's incorporated in a possession of the United States, like Puerto Rico.
Okay.
Or second, if it's eligible for benefits of a comprehensive income tax treaty with the U.S. that the Treasury Department has deemed satisfactory, and which includes an exchange of information program. The IRS even provides specific guidance and lists of such treaties in publications like Notice 2011-64.
So you can actually look that up.
You can. Now, if it doesn't meet either of those two criteria, it may still be treated as qualified if the stock associated with the dividend is readily tradable on an established securities market in the United States.
Like the New York Stock Exchange or NASDAQ.
Exactly. This applies to many foreign companies whose stock is listed and actively traded on U.S. exchanges. However, even then, there are additional requirements and considerations, which are outlined in further IRS guidance, like Notices 2003-71 and 2006-3. It's not just any foreign company. It has to meet these specific qualifications.
And it's also important to point out that certain foreign corporations are explicitly not qualified, correct? Like passive foreign investment companies, or PFICs.
Right. PFICs have their own very complex tax rules.
Or certain surrogate foreign corporations if they became a surrogate after December 22, 2017.
That's correct. The intent behind those exclusions is generally to prevent certain tax avoidance strategies or to ensure the proper taxation of investments that operate under different international tax regimes. And a small technical detail.
Sure.
The amount in Box 1B for qualified dividends can never be a negative number. If calculations somehow result in a negative amount, it should simply be reported as zero.
So, to summarize our deep dive into Box 1B, this is where you identify potentially lower tax rates, but the rules are very specific, especially regarding your holding periods and the type of foreign corporation. It's a prime example of how a bit of knowledge about your 1099 DIV can lead to tangible tax benefits, directly impacting what you pay the IRS. It truly is a tax-saving powerhouse if you know what to look for and how to qualify. Now, let's explore other types of distributions that can also have significant and varied tax implications. Having explored the fascinating world of ordinary and qualified dividends, let's now pivot to another powerful section of this form: capital gain distributions, starting with Box 2A. Total capital gain distributions. What exactly does this box signify for an investor, and why should we pay close attention?
Okay, Box 2A reports your total capital gain distributions. These are primarily long-term capital gains that have been passed through to you from investments like mutual funds or other regulated investment companies, or RICs.
So the fund makes a profit and passes it on?
Exactly. Imagine the fund itself sells stocks or other assets within its portfolio, and it realizes a profit. Instead of keeping that profit, it distributes your share of those gains to you. That's what lands in Box 2A.
Okay.
And here's the crucial benefit. Like qualified dividends, these capital gain distributions are generally taxed at those favorable long-term capital gains rates.
More potential savings.
Yes. As we discuss, these are often significantly lower than your ordinary income rates, representing another key area for tax optimization. Think of Box 2A as the aggregate, the grand total, of more specific capital gain types that are then broken down further in the subsequent boxes.
So 2A is the big picture, and then we dive deeper into some really specific capital gain types in boxes 2B, 2C, and Tech-End. This is where we might find even more potential for tailored tax savings, especially with box 2C, which sounds like it could be a truly game-changing opportunity for some. Let's start with box 2B first, though.
Right, Box 2B is for unrecaptured Section 1250 gain. This is a highly specific type of gain that typically originates from the sale of certain depreciable real property.
So likely from real estate funds.
You might see this if you invest in real estate-focused mutual funds or real estate investment trusts, or REITs, yes.
Yeah.
The important thing to know is that this particular gain is subject to a maximum federal tax rate of 25%.
25%, okay.
While it's higher than the general long-term capital gains rates, which can be 0%, 15%, or 20%, it's still likely lower than your top ordinary income tax rates, and it's specifically carved out to ensure accurate reporting for these types of assets. It's a niche, but important if it applies to you.
And then the highly anticipated Box 2C Section 1202 gain. This is a game changer for certain investors. It's the Qualified Small Business Stock, or QSBS, exclusion. I've heard this can be a truly massive tax advantage. How powerful is this? And what's the core insight for our listeners here?
You're absolutely right. This box represents a truly remarkable tax advantage. Box 2C reports gain from what's known as Qualified Small Business Stock, and it may be eligible for a significant exclusion from capital gains tax.
How significant?
We're talking about a 50%, 60%, 75%, or even a truly astonishing 100% exclusion from gain on the sale or exchange of this stock, provided you meet some very specific critical conditions.
100%.
Potentially, yes. This isn't just a minor deduction. It's a fundamental shift in how that income is taxed, making it a major tax-saving powerhouse for those who qualify.
A 100% exclusion means potentially no federal tax on a substantial portion of your gain. That's incredible. What are the absolute key conditions a listener needs to be aware of if they want to even dream of this exclusion?
The conditions are absolutely critical and must be strictly met. First, the stock must have been originally issued by the qualified small business after August 10, 1993, so older stock doesn't count.
Okay.
Second, and this is non-negotiable, you must have held that stock for more than 5 years. That long holding period is fundamental to qualifying for this incredible benefit.
More than 5 years. Got it.
Now, regarding those varying exclusion percentages, it depends on the precise date you acquired the stock. It gets a little granular here.
Let's hear it.
And for stock acquired after August 10, 1993, but generally before February 18, 2009, you could qualify for a 50% exclusion. If it was Empowerment Zone business stock acquired after December 21, 2000, and before December 31, 2018, that exclusion jumps to 60%.
Okay.
For stock acquired after February 17, 2009, and before September 28, 2010, it's a 75% exclusion. And for stock acquired on or after September 28, 2010, well, the rules have evolved, but this period saw the potential for a truly remarkable 100% exclusion. The instructions mention 100% for stock acquired before January 4, 2014, but it's worth noting the 100% exclusion was made permanent for stock acquired after September 27, 2010.
Wow. So the acquisition day is crucial.
Absolutely crucial. And if you have an amount in Box 2C, the payer is actually required to furnish you with a separate statement detailing the name of the issuing corporation, the date you sold the stock, your share of the sales price and basis, and the exact amount of your Section 12 gain and the applicable exclusion percentage.
So you get the details you need.
Yes, your tax professional will use these details to apply the correct percentage.
That is an immense value. It's not just a minor deduction. This could genuinely mean paying no federal tax on a substantial portion of your gain. This is a game changer for entrepreneurs and early investors in small businesses. This is the kind of insight that truly empowers you as an investor. And then Box Taken, what's that?
Box Taken reports collectibles, 28% gain. This is gain that results from the sale or exchange of collectibles.
Yeah.
We're talking about things like art, rare coins, stamps, antiques, or precious metals.
Okay.
These items are generally taxed at a higher maximum long-term capital gains rate of 28% for federal purposes, which is why they have their own specific box to differentiate them from other capital gains. It's a reminder that not all capital gains are created equal in the eyes of the IRS.
Fascinating. So clearly not all capital gains are treated equally, and these boxes help us pinpoint which rules apply. Let's briefly circle back to those Section 404K dividends we mentioned earlier, just to definitively clarify their tax treatment within the context of these boxes.
Right? Good idea. To reiterate, these dividends are direct payments from corporations to plan participants or beneficiaries from employer securities. They are reported as ordinary dividends in Box 1A.
Box 1A, ordinary income.
Correct. A key point here is that they are not subject to backup withholding, and perhaps most importantly for your tax planning, they are explicitly not eligible for the reduced capital gains rates that qualified dividends in Box 1B enjoy. So they don't get that preferential tax break. They're treated as regular income.
Good to know. Now, let's turn our attention to regulated investment companies and real estate investment trusts, or REITs and REITs. These often come with their own unique set of rules and, you guessed it, more potential for specific deductions that could benefit your tax return. Tell us about qualified REIT dividends in Box 5.
Okay, Box 5 is for qualified REIT dividends paid by a REIT or Section 199A dividends paid by a RIC. For certain taxpayers, these amounts can qualify for a significant deduction under Section 199AA, which is also known as the Qualified Business Income Deduction.
The QBI deduction.
Exactly. Generally, a qualified REIT dividend is a dividend from a REIT that is not a capital gain dividend or a qualified dividend. It has its own unique classification.
Another special category.
Yes. And there's also a holding period for REITs to qualify for this deduction. You must hold the REIT stock for more than 45 days during a 91-day period surrounding the ex-dividend date, and you still exclude those risk-diminished days, similar to qualified dividends.
So similar holding rules apply.
Right, it's just the IRS wants to ensure genuine investment intent. And UCCs have a special ability here. If they receive qualified REIT dividends, they can actually pass them through to their own shareholders as Section 199A dividends, which the shareholders can then treat as qualified REIT dividends, subject to their own holding period requirements for the REIT shares. It's a pass-through benefit.
So this is a specific benefit that really encourages investment in real estate via REITs, offering another potential deduction on your tax return. Another area for smart tax optimization. What about this interesting nuance regarding dividend payments that are delayed until January? That seems like it could trip people up.
This is a specific, somewhat counterintuitive rule for RICs and REITs, and it's important to be aware of. If they declare a dividend in October, November, or December, payable to shareholders of record in those months, but they actually pay it in January of the following year,
Okay.
the IRS treats it as if it was paid and received on December 34th of the prior year for tax reporting purposes.
Whoa, okay. So the payment hits your bank account in January, but it counts for last year's taxes.
Exactly. So the reporting implication is, if you receive a payment in January, it might appear on your 1099 DIV for the previous year.
Yeah.
It's really important to remember when you're gathering your tax documents so you're not scratching your head trying to figure out where that income came from on your current year's form. It's a timing anomaly.
Definitely something to flag.
Precisely. And there's a unique backup withholding anomaly that goes along with this rule. If backup withholding applies to that dividend, it actually occurs in January when the dividend is physically paid.
Right, when the cash flows.
However, because the dividend itself is reportable on the Form 1099 DIV for the prior year, that related backup withholding is also reported on the prior year's Form 1099 DIV, even though the actual withholding happened in the new calendar year.
That's confusing but important to know. A specific timing disconnect.
It is. Also quickly, for those dealing with very specific entities, we have Section 897 gain, which can show up in boxes 2E and 2F. This applies if a RIC or REIT disposes of a U.S. real property interest or USRPI at a gain.
Okay.
Any distributions attributable to such gain are treated as recognized gain by the recipient from the disposition of a USRPI. However, this is largely for informational purposes for the issuing RICs and REITs. These boxes are generally not completed for recipients who are U.S. individuals. It's more of an internal reporting mechanism.
Got it. And finally for this segment, a quick mention of tax credit bonds. How do those factor in?
Right. If a RIC or REIT holds certain tax credit bonds, any bond tax credit allowed to them is actually included as interest income in their gross income. What's interesting is that RICs have the option to elect to distribute these bond tax credits to their shareholders.
Oh.
When they do, they're typically reported on Form 1097 BTC, which is specifically for bond tax credits, but they can also be included on Form 1099 DIV if they're treated as dividends. It's another layer of complexity that can yield specific beneficial tax advantages if your investments fall into this niche area.
We're almost through our comprehensive tour of the Form 1099 DIV, and as we've seen, each box tells its own story and carries its own specific tax implication. Let's move on to Box 3, non-dividend distributions. This sounds a bit like a mystery box. What exactly are these, and why aren't they just called, well, dividends?
Non-dividend distributions are exactly that. They're not considered taxable dividends. Instead, they're essentially a return of capital.
Return of capital. Okay.
This means the company or fund is returning a portion of your original investment back to you, rather than paying out profits. Think of it as getting back some of the money you initially put in. These distributions are not considered taxable income initially. Instead, their primary effect is to reduce your cost basis in the investment.
So if I invested $100 in a stock and then receive a $10 non-dividend distribution, my new cost basis for tax purposes is now $90. That sounds good. It's like a tax-free cash flow, at least at first. But what happens if my basis gets reduced all the way to zero? Can it still be tax-free then?
That's the crucial clarification and a very common question. Once your cost basis is reduced all the way down to zero, any further non-dividend distributions you receive beyond that point do become taxable.
Ah, okay.
At that point, they are generally treated as capital gains. So while they start out tax-free by reducing basis, they don't necessarily stay that way forever. Corporations that pay these types of distributions are required to file Form 4552 with the IRS, which tracks these reductions in capital.
All right, on to Box 4, Federal Income Tax Withheld. This box seems pretty straightforward, showing tax already paid. But often if you see an amount here, it's a signal of something else happening behind the scenes, isn't it?
It is. This box simply shows any federal income tax that was already withheld from your dividend payments. The most common reason you'd see an amount here, and it's something to pay attention to, is backup withholding.
Backup withholding.
It's the IRS's way of ensuring they get their tax dollars if certain information is missing or incorrect.
And why exactly would backup withholding occur? It sounds a bit like a penalty.
It's not necessarily a penalty on you, but rather an enforcement mechanism. Typically, it happens for one of two main reasons. The primary reason is that you haven't furnished your proper taxpayer identification number, like your Social Security number, to the payer in the manner required.
Okay, missing TIN.
Or, perhaps more concerning, the IRS has notified the payer that you previously provided an incorrect TIN. In either case, the payer then has an obligation to withhold a certain percentage, currently 24%, of your payments directly.
24%. Ouch.
Yes, it's significant. My practical advice here is very straightforward. If you see an amount in Box 4 and weren't expecting it, or you're unsure why it's there, it's a clear signal to immediately contact your payer and ensure they have your correct TIN on file.
Good advice.
You can use Form W-9 to request your TIN if you're a U.S. recipient, or the applicable Form W-8 if you're a foreign recipient. Resolving this quickly can prevent future withholding and headaches.
Good practical advice. Always check your TIN. Now, Box 6, investment expenses. This one can feel a little bit like phantom income to the recipient, can it? You're taxed on it, but it doesn't feel like you directly received it or can easily deduct it.
It absolutely can, and it's a point of frustration for many investors. Box 6 reports your pro rata share of certain amounts that are deductible by a non-publicly offered regulated investment company, RIC, in computing its own taxable income.
Okay.
The key thing for you as the individual recipient is that this amount is includable in your gross income. It's also already part of the amount you see in Box 1A, total ordinary dividends.
So it's already baked into Box 1A.
Correct. However, and this is the phantom income part, under current tax law, these investment expenses are generally not deductible by individual investors.
Oh, really? Not deductible?
Generally not, due to changes from the Tax Cuts and Jobs Act related to miscellaneous itemized deductions. So you're taxed on that income, which you didn't directly receive as cash, but you don't get a corresponding deduction for the associated expense. It's certainly a situation where you're paying tax on something that didn't directly translate into a tangible cash distribution or a tax write-off for you. It's important to understand so you're not confused by the numbers.
That can definitely be frustrating for investors. Bit of a bitter pill to swallow. Let's move to Boxes 7 and 8, foreign tax paid and foreign country or U.S. possession. This sounds like another potential opportunity for valuable tax credits, especially for those with international investments.
It is, and it's a significant benefit designed to prevent double taxation. Box 7 shows the amount of foreign tax that was paid on dividends you received from foreign stocks or from mutual funds that invest internationally. Box 8, if completed, identifies the specific foreign country or U.S. possession where that tax was paid.
And the potential benefit here is massive. This amount may allow you to claim a foreign tax credit on your U.S. tax return, helping to avoid double taxation on your international investments. That's a huge plus for those diversifying globally, ensuring your global profits aren't eaten away by two tax authorities.
Exactly. It's designed to prevent you from being taxed twice on the same income, once by the foreign country and once by the U.S. For RICs specifically, they are not required to complete Box 8, as regulatory changes have removed the country-by-country reporting requirement to shareholders for the amount in Box 7. They just report the total.
Okay. But the credit opportunity is still there.
Absolutely. The principle of the credit remains.
All right, Box 9 and 10, liquidation distributions. This sounds like a more unusual occurrence for the average investor. What exactly triggers these, and how are they treated?
These boxes come into play when a company undergoes a partial or complete liquidation. This means the company is essentially winding down its operations or selling off significant assets and then distributing the proceeds to its shareholders.
Okay.
Box 9 is specifically for cash distributions received as part of that liquidation, while Box 10 is for non-cash distributions, which are reported at their fair market value as of the date of distribution. So if you receive, I don't know, a piece of equipment instead of cash, that value would go here.
And these are not included in Box 1A or 1B, which tells me they're taxed differently than your typical dividends. How so?
Correct. They are taxed distinctly, and it's crucial to understand the difference. They're often treated as a return of capital, similar to those non-dividend distributions in Box 3, until your basis is reduced to zero.
So reduce basis first.
Exactly. After that, any further distributions are generally treated as a capital gain or loss, depending on your stock's basis. They are not considered ordinary dividend income, reflecting the fundamental change in the company's structure or existence.
Then there's Box 11, FATCI filing requirement. What does that signify for us? It sounds like a large global initiative.
It is. This box is checked by U.S. payers who are reporting on Form 1099 DIV as part of satisfying the requirement to report U.S. accounts for purposes of Chapter 4 of the Internal Revenue Code, which is related to FATCI, the Foreign Account Tax Compliance Act.
Okay.
It can also be checked by foreign financial institutions reporting payments to a U.S. account. While it's less directly applicable to you as an individual recipient, as you don't take any direct action based on it, it signifies the global effort toward tax transparency and combating offshore tax evasion. It's part of a much larger international data exchange.
Good to know what it means. And now for another area that can be a truly major tax saver and a real perk for savvy investors. Boxes 12 and 13, exempt interest dividends, and specified private activity bond interest dividends. This sounds like a great opportunity to keep more of your money.
It absolutely is. This is fantastic news for anyone looking to reduce their taxable income. Box 12 reports exempt interest dividends that you receive from a mutual fund or another RIC.
Okay.
These dividends are typically derived from investments in municipal bonds, and the truly excellent news is that they are generally not taxable at the federal level.
Not taxable federally. That's huge.
It represents a significant benefit, especially for investors in higher income tax brackets who are seeking to optimize their after-tax returns.
So genuinely tax-advantaged income, that's a rare and beautiful thing. And Box 13 is a subset of that, right, with a bit of a nuance.
Exactly. Box 13 is specifically for interest from specified private activity bonds, and it's a portion of the total amount you see in Box 12. These are particular types of municipal bonds that are issued for private business use rather than purely for public purposes.
Okay, private activity bonds.
Now, here's the crucial nuance. While these dividends are federally tax-exempt, they might still be subject to state or local income taxes, depending on your state's laws and whether the bond was issued in your state.
Ah, the state tax trap.
Right. So a bond issued in California might be tax-exempt federally and in California, but taxable if you live in, say, New York. And interest from private activity bonds can sometimes be subject to the alternative minimum tax, or AMT, for certain higher income taxpayers.
The AMT. Another layer.
So exempt doesn't always mean entirely free of all taxes, but it's still a huge federal advantage.
That's a vital distinction. Federal exemption doesn't always mean total exemption. But still, for those seeking income diversification with significant federal tax benefits, these boxes are definitely worth exploring and can be a major win for your tax planning strategy. Finally, boxes 14 through 16, state information. These seem a bit more straightforward.
Yes, these boxes are purely for your convenience and for your state tax reporting purposes. They are not completed for the IRS. They're strictly for your state tax return.
Okay.
Box 14 will typically show the abbreviated name of the state. Box 15 is for the payer's state identification number, and Box 16 will list any state income tax that was withheld on your payment. The payer will typically give you copy 2 of Form 1099 DIV for use in filing your state income tax return. It's just an added convenience, saving you the trouble of looking up that information yourself.
We've journeyed through every single box of the Form 1099 DIV, uncovering the layers of meaning and implications within each number. Now let's bring it all back home and talk about what this means for you, the listener, and your next steps when that form lands in your mailbox or digital inbox. First, just a quick reminder about your copy of the form itself.
Right. As the recipient, you are legally required to be provided with a statement, specifically copy B, of Form 1099 DIV by the payer. This is your official record, and it's the document you'll use directly to prepare your federal income tax return.
So don't toss it.
Definitely don't toss it. Don't ignore it or assume it's just for your records. It's essential for accurate filing.
And for security purposes, I know payers are allowed to truncate your taxpayer identification number, or TIN, on the copy you receive. Can you quickly explain that? It always feels a bit odd seeing those XXs.
Yes, it's a security measure. For your protection, payers are indeed allowed to truncate your TIN, whether it's your Social Security number, ITN, 8N, or EIN, on the pay statements, which is the copy you actually receive. This means they can show only the last 4 digits, like XXXX1234.
Okay.
However, it's critical to remember that this truncation is not allowed on the forms they file directly with the IRS. The IRS receives your full TIN.
Good to know.
And conversely, the payer's own TIN can never be truncated on any form for accountability purposes.
Yeah.
There's also a small, rather cryptic second TIN not box on the form. What's that about? It sounds ominous.
Yeah, what is that?
It sounds more serious than it usually is for the recipient. This is entirely for the payer's internal use and their communication with the IRS. If the IRS has notified them twice within 3 calendar years that you, the payee, provided an incorrect TIN, they would mark this box. It triggers specific IRS actions and further notices for the payer regarding their obligation to start or continue backup withholding. It's definitely not something you, as the recipient, would ever mark or be directly involved in marking. It's a signal to the payer from the IRS about your TIN accuracy.
Got it. And finally, what about the account number field? Is that always necessary?
An account number is required if a payer has multiple accounts for a single recipient, and they are filing more than one Form 1099 DIV for you. Makes sense for tracking.
Right.
It's also required if the FACA filing requirement box 11, is checked. Beyond those specific instances, the IRS actually encourages payers to designate an account number for all Forms 1099 DIV they file.
Why is that?
It simply helps organize information, especially if you have numerous investment accounts with the same brokerage, making it easier for both you and the IRS to reconcile specific transactions to specific accounts.
Okay, so we've journeyed through each box of the Form 1099 DIV. And what's truly fascinating here is that each number isn't just data. It's a specific type of income or a specific tax treatment with a distinct consequence for your taxes.
Absolutely.
Understanding these distinctions is the key not just to accurate tax filing, but to truly identifying and leveraging potential tax benefits and optimizing your financial situation. It really is about turning a seemingly mundane tax form into a map of opportunities.
Well said. It transforms your perspective on these forms.
So here's the practical implication for you, the listener. Next time you receive your 1099 DIV, you won't just see a jumble of numbers on a confusing form. You'll see opportunities clearly laid out. You'll know to specifically look at Box 1B for qualified dividends and those lower tax rates that can make a real difference. You'll eagerly check Box 2C for potential qualified small business stock exclusions, which, as we discussed, could be a truly immense tax saver.
Potentially life-changing for some investments.
Right. And you'll definitely want to spot boxes 12 and 13 for exempt interest dividends, which offer truly tax-advantaged income at the federal level. This knowledge empowers you to confidently review your investment income, understand its true tax nature, and potentially leverage these significant tax advantages. It puts you in the driver's seat of your tax planning.
Exactly. This deep dive should raise an important question for every investor. Beyond just basic compliance, are you actively analyzing your investment income statements for these specific tax attributes? Are you looking for these nuanced details that could fundamentally benefit you?
That's the key question.
Because knowledge, in this context, truly is power for your personal finances. It allows you to maximize your returns not just through smart investment performance, but through even smarter tax planning. It transforms your tax forms from a burden into a tool. Hashtag outro.
What an incredible deep dive into the 1099 DIV. We've uncovered the true power of qualified dividends and their lower tax rates, the truly incredible potential of Section 1202 gains, and the distinct advantages of exempt interest dividends.
Key takeaways right there.
These aren't just obscure tax codes. They are real, actionable opportunities for significant tax savings that are waiting for you to discover.
We've seen how understanding just one form, the 1099 DIV, can unlock a surprising number of specific tax insights and even significant savings for your bottom line. This brings up a bigger thought for you to consider beyond this deep dive.
Oh,
If just one common financial document holds such detailed nuances and potential benefits, what other income or investment forms might be hiding similar surprising details or unexpected opportunities that could quietly optimize your overall financial picture? There's always more to learn and more to gain by simply digging a little deeper into your own financial documents.
absolutely. A great point. So go ahead, approach your financial documents with this newfound informed curiosity. It could genuinely pay off. Thank you for joining us on this deep dive. Until next time, stay informed and happy planning.